Welcome to the Deep Dive. We cut through the noise of earnings calls to bring you what really matters. Today, we're taking a focused look at Viking Holdings LTD and their second quarter 2025 performance. We'll unpack the latest financials, their strategic moves, and how the market is reading their path forward. You ready for a sharp analysis on what's key for investors and anyone interested in luxury travel?
Yeah, Viking certainly delivered strong Q2 numbers, at least on paper. Revenue went up to $1.88 billion. That's an 18.5% jump year over year, which, pretty handily beat what analysts were predicting. And Adjusted EBITDA, even stronger growth there, up 28.5% year over year, hitting $632.9 million.
And profits look good too, right? GAAP and Adjusted EPS landed smack on the estimate, 0.9 and 99. They also showed some really solid operational efficiency. Their net yield, basically what they earn per passenger per day, they came in at $607, which is an 8% increase from last year. And the ships were full, occupancy holding high at 95.6%?
Exactly, 95.6%. But here's the interesting part. Despite these really quite compelling headline figures, the market was initially cautious. Yeah, the shares traded noticeably lower in pre-market and when the market opened. It signals investors were digging into specifics, maybe beyond those top-line beats, and the trading volume was way higher than average. Clearly shows the market was actively processing this news.
Okay, so strong top line, solid EPS, good yield, but the market hesitates. You mentioned investors scrutinizing specifics. What do you think they were zeroing in on? Let's really dig into the financial health details and the strategy bits that might explain that caution.
Absolutely. Investors are always looking past the headlines, right? They want the drivers, the future outlook. So zooming in, Q2 was definitely strong. $1.88 billion revenue, up 18.5%. Adjusted EBITDA, $632.9 million, up 28.5%. Net income also up to $439.2 million. And the main drivers for this were, increased capacity, higher occupancy, definitely, and also improved revenue per passenger cruise day, that PCD metric.
That's a solid base for the quarter. But what about the bigger picture? Their overall financial health. How are they positioned long term?
This is where Viking looks pretty robust. They're sitting on a really significant cash pile, $2.6 billion in cash and equivalents. And crucially, they have $4.4 billion in deferred revenue. That's money already booked for future trips.
Wow, $4.4 billion booked ahead.
Yeah, it's like prepaid vacations on their books. It gives them a huge operational advantage, predictability, a financial cushion. Plus, their net leverage is at a healthy 2.1 times. It shows they aren't overextended, even with their growth plans.
Okay, that cash position and the deferred revenue, that does paint a very healthy picture. It looks incredibly strong. Are there any, potential headwinds hidden on the balance sheet we should know about, or is it really that robust?
As far as reported, it seems genuinely solid. They've shown a lot of discipline, which actually connects nicely to their booking status. And this is where Viking really shines, giving that strong forward visibility.
That's what really jumps out at me too, the sheer volume of those advanced bookings. They're in an incredibly strong position. For 2025, get this, 96% of their core product capacity is already sold. They've basically sold out the year. And you can see they're already focused hard on 2026. 55% of that year's capacity is already booked as of early August. That's quite a head start.
And putting numbers on it, advanced bookings for 2025 are at $5.64 billion. That's up 21% from the same time last year, even with 12% more capacity online. For 2026, they've already locked in $3.88 billion. That's 13% higher than 2025 was at this point last year. That kind of visibility, is pretty unique and incredibly valuable in the travel sector.
It's a fantastic sales rate for 25. Yep. You mentioned the market's hesitation. Does the 2026 pricing growth maybe temper things a bit? Is this like a normal pattern, or could it signal something investors need to watch, like maybe supply catching up a bit? Because that slight moderation in pricing growth, even with strong bookings, that feels like the core of the market's concern you mentioned.
You've absolutely nailed it. That seems to be the crux. Okay, so advanced bookings per PCD for 2025, up a solid 7% year over year, hitting $784. But for 2026, they're up 4% year over year to $866, comparing to where 2025 was at this same point. Now, management reiterated their goal, mid-single-digit price increases for 2026. But that slight slowdown in the rate of price growth for 26, despite the bookings, that appears to be the main focus point for the market's caution. It's not necessarily weak demand, maybe more about filling ships earlier, or just a slight adjustment as things normalize post-pandemic. Investors are just super sensitive to pricing power, especially at the premium end.
Right, that makes sense. Balancing filling the ships versus pushing that premium price. And they're definitely still growing the fleet, aren't they? They just keep adding capacity. Since Q1, they took delivery of the Viking Vesta, that's an ocean vessel, and the Viking Amun for the Nile in Egypt.
That's right. And looking ahead, they expect 6 more river vessels just in the second half of this year, 2025. Plus, they announced new India River trips starting 2027-28 with 2 dedicated ships. And the early response, phenomenal. They said all available itineraries sold out almost immediately.
Wow.
Yeah, it shows that selective expansion into these high-value, maybe less common destinations is working. They also briefly mentioned the Viking Idun operating in China for the Asian market. Still early days there, but it's future potential.
So clearly growing, but growth brings challenges, right?
Yeah.
Especially managing costs as you scale up. How are they handling that while keeping that unique Viking brand intact? I mean, their whole thing is destination focus, no kids, no casinos, no nickel and diming. It's about that cultural immersion for affluent, loyal guests.
Exactly. And on costs, yes, vessel expenses and SG&A selling general admin costs, they did increase. Management pointed to itinerary mix changes, higher port fees, and just ongoing investment in their teams, sales, marketing, things you need for future growth. But, and this is important, look at the operating leverage. For the first half of 2025, operating expenses, if you exclude fuel, were up only 3.9%. Compare that to 11% capacity growth and 7.6% yield growth. It shows they're managing to grow revenue and profit much faster than core operating costs. That's strong execution.
That leverage point is key for profitability to catch. What about currency? Big global operation, lots of euros involved, I imagine. How are they managing that risk?
They seem pretty smart about it. They've hedged a lot of the euro exposure for operating expenses. For 2025, it's about $470 million hedged, and for 2026, $500 million. This helps protect them from those currency swings that can really mess with quarterly numbers, gives them more predictability. And they've also naturally hedged some euro-denominated loans by holding equivalent cash in euros. Smart way to avoid taking unnecessary currency hits on the balance sheet.
Yeah, discipline on costs, smart on currency. Now capital allocation. Management was clear. No near-term dividends or share buybacks. The priority is growth, keeping that big $2.6 billion cash reserve for flexibility and seizing contrarian opportunities, as they put it. Can you elaborate on what those contrarian opportunities might look like? And how does negotiating directly with shipyards play into that?
That's a really key part of their playbook. Their ability to contract new ships at good prices comes from negotiating directly with yards and using standardized designs. They're not just buying off the shelf.
Right.
This gives them leverage. So contrarian opportunities could be snagging even better deals on new ships if shipyards hit a downturn, or maybe strategic partnerships, things that enhance the unique offering. They also highlighted the payback periods, 5-6 years for ocean ships, a very quick 4 or 5 years for river ships. And that's before you even factor in the benefit of all that deferred revenue. It really signals a long-term view.
So the whole story around Viking has definitely shifted since the IPO back in 2024. It's gone from post-pandemic recovery to, well, scaled premium growth. But what's the core question for investors now, especially with that slight moderation in 2026 pricing we talked about?
Yeah, the core question now really centers on, can they keep that pricing power while they continue this pretty aggressive capacity expansion? It's that classic tension for premium brands, growth versus margin. How do you balance both?
And while those advanced bookings and occupancy rates are, undeniably positive, that slight easing in the 2026 price growth rate is getting the scrutiny, especially when you look at how well Viking stock has done compared to the broader market. Over the last 3 months, Viking's up over 25%, while the consumer discretionary ETF XLY was up just over 6%. Over the year, Viking's up more than 66% versus XLY's 26%. So the market has clearly loved the story. But it did lag XLY just in the past month. It really feels like the market's putting more weight on that 2026 pricing momentum than maybe management's focus on just selling out the ships and adding capacity.
Exactly right. Management, for their part, reaffirmed that mid-single-digit price increase goal. They feel it's achievable, especially given their already high average price per day, $800 to $900 across their different products. Their confidence really stems from having this unique destination-focused product that appeals strongly to a loyal, affluent group. That's key to sustaining that premium position. Even with the slight moderation we're seeing, it's all about that brand loyalty.
All right, let's shift gears. Time for our wild yet plausible trade ideas segment. Okay, so we've just heard about Viking's strategy. Prioritize long-term growth, keep a huge cash stash for contrarian moves, and their knack for getting good deals on ships through direct negotiation and standard designs. They clearly like controlling their destiny. So, my outrageous but plausible idea today is the Viking Shipyard strategic acquisition. Here's the pitch. Viking sees the bottleneck in building the specialized river and smaller ocean vessels they prefer. It's a niche market, so they quietly use some of that $2.6 billion cash pile to take a major stake in, or maybe even acquire outright a smaller, perhaps struggling but strategically located European shipyard. This isn't just buying capacity like anyone else. No, it's a strategic play to really cement, as they might say, their supply chain, guaranteeing better prices, guaranteed delivery slots, total flexibility. Why plausible? Well, shipyard valuations can be pretty cyclical, often depressed. Viking, with its cash and that contrarian mindset, could potentially pick up this vital asset at a fraction of its long-term strategic value to them. Then the reveal.
Viking announces exclusive or priority access to this revitalized shipyard. Boom. They've vertically integrated a critical piece of their growth machine. The market then have to reevaluate Viking not just as a cruise line, but as this integrated travel and shipbuilding powerhouse. Think of the competitive edge, long-term cost control. It screams owner's mentality.
Okay. Let's bring it back down to earth for a quick recap. Viking Holdings LTD, strong Q2 2025. They beat on revenue, showed robust Adjusted EBITDA growth.
Yeah, top-line performance looked great, and those 2025 and 2026 booking levels are, frankly, impressive. But the market's initial take suggests a real focus, maybe even concern, about that slight moderation in the 2026 pricing growth.
Definitely. But the company's strategic expansion, their very healthy balance sheet, that disciplined capital approach, it all points towards a clear long-term growth path for Viking.
Yeah.
And just a reminder for everyone listening, this information is purely for educational purposes. It is absolutely not financial advice. Please do your own research, consult with a financial professional before making any investment decisions.
So it leaves you thinking, doesn't it? Given Viking's deep pipeline of future bookings, that unique product niche, how much weight should investors really put on a tiny slowdown in price growth for 2026 versus their amazing ability to sell out ships years in advance? Where does the true value really lie? Thanks for tuning into the deep dive. We appreciate you listening and encourage you to share your thoughts. Until next time.